This is level 2 of the CFA program, the topic on alternative investments and the reading on real estate investments. I was curious about how this was treated when I went through the program hundreds of years ago, and I couldn't find my old-time books, but I did find books that were published about a decade ago. And this concept of real estate was embedded in a reading called An Introduction to Alternative Investments. And so I tell you that just so you can get a sense of how this topic has expanded. Now it's a huge reading, and there's lots and lots of really, really good stuff in here. I also mentioned that to try to focus your attention, at least in the beginning here, of the similarities between this asset class known as alternative investments and all the other stuff we've been doing back in level 1 and currently in level 2 with fixed income securities and equity securities. So let me just go ahead and start off by reminding you of those similarities. Investors look essentially for two things, right? They look for income and they look for capital gains. Well, that's of course is true here in alternative investments and in specifically to real estate investments. Now, of course, the terminology changes, and you'll see that as we go through the LOSs and the slide deck. But I also want to remind you of all of what we learned from Modigliani and Miller, that the quality of an asset, the quality of a fixed income security, the quality of an equity security, and now, of course, the quality of real estate depends primarily on two things: the ability of the asset to generate cash flow, and then, of course, how much does it cost in terms of an interest rate to finance the investment in that particular asset class. And you'll see the similarities as we go through these learning outcome statements. But then again, of course, you have to focus on the differences because there are some unique characteristics. And that's why real estate is in this other asset class. So notice what we'll do here in these LOSs. We'll start out with some characteristics and then some risks. And that's probably among the more important one. Then we'll talk about property types and due diligence, some indexes, and then some methods to value some properties. And then we'll continue moving on. Look at a couple of these. You know, we've done things like discounted cash flow. We've done things like financial ratios. And then we'll talk about a couple of unique securities inside of this asset class. And we'll talk about cash flow and look at this use of funds from operations and adjusted funds from operations. So these are all similar, not identical, but similar to what we've talked about. And then the Institute likes to have a final LOS, as you know, that sounds something like, okay, tell me everything about this particular reading and tell me why it's good and tell me why it's not so good. So there's some advantages and disadvantages. So let's go ahead and get right to this. Of course, two big differences here, residential and non-residential. I'm guessing you don't need me to cover this slide, but I think this is probably a really good introductory exam question for this topic about the difference between the owner-occupied and rent for both residential and non-residential. How about some basic forms of real estate? Private equity. Look down there on the bottom left. So the private REITs and then the private real estate operating companies. So we'll talk a little bit more about those as we go through the slide deck. Private debt, mortgages, and bank debt. And remember, back in the old days, and when I say old days, I mean, you know, let's go back to 1930 and 1950 and 1970. This private equity and private debt market, as it related to real estate, was super small compared to what it is now. It has substantially grown. And of course, on the right-hand side of this table, we have publicly traded equity and publicly traded debt. And so regular old investors like you and I, regular meaning, you know, just those of us who don't have millions or billions of dollars to invest. No offense to your personal wealth situations. Notice the bottom circle points down there. Debt has a priority claim over equity. That makes perfect sense. No different from what we've talked about in the past. And then that last embedded circle point there, that is directly out of Modigliani and Miller, 1958. Value of the equity is equal to the value of the asset, or the property in this case, minus anything that we owe. This is probably a good kind of a multiple choice question for the exam. The Institute could give you some characteristics of a property and say something like, okay, which one of these is most defined by the scenario above? So what do we know about simple and basic characteristics? Heterogeneity means, of course, that my house right here is not the same as the house across the street, even though we might live in the same neighborhood. So an apartment building right here might not be the same as an apartment building right across the street. Notice that final comment there. Two properties cannot be exactly the same. High unit value, management intensive, high transaction costs. Those make lots of sense, because if we're managing this particular apartment building and somebody else is managing that particular apartment building right across the street, well, they're going to have differences, because, you can't chop them. They're indivisible. I mean, people try to chop them into different things, but it's not always easy or efficient. And then, of course, the plumbing is going to go, the air conditioner is going to go, and you'll have to have active and intensive management. And that leads directly into high transaction costs, not only in the operations, but especially when we're buying or selling or leasing or renting. Depreciation, of course, is super important. When we have a brand new office building, we can depreciate the entire amount, but then, people come in, they use our building, and they wear out over time. So depreciation here is exactly like it has been in terms of the accounting side, where we'll be able to take a depreciation expense. However, we also need to worry about the actual wear and tear of that asset over time. And then, of course, that last one is important, the need for debt financing. What that means implicitly is that when interest rates are high, then the weighted average cost of capital is going to be higher, and then the value of that property is going to be low. And then the other part of that is when interest rates are high, then debt capital is scarce. So remember that last diamond point. Final two, illiquidity. That's a perfect one here that I'm guessing you know already. Difficulty in determining price. It's not like I sell my house every day or every week. Actually, we lived in our house now 20 years, so who knows what the value of our house is. We could hire someone to come in and appraise it and assess it and do all that kind of stuff and say, hey, you know what, Jim, I think your house is worth, this amount, and that's probably not going to be right anyway. I like these principal risks here. This is probably a really good question. Think about the question stem up at the top, or a vignette where they list a whole bunch of things and say, okay, this is a biggest concern because of, and then you can list some of the reasons in the answers. Business conditions, this is always a huge one. All those macroeconomic variables that we talked about back in that specific reading about interest rates and inflation. I mean, inflation is super important here, as we'll see going through the slide deck, but also general business conditions, which are measured most likely by GDP or some other measure of economic growth. And then some other risk factors that you could probably guess. Cost and availability of capital. Once again, that probably depends on interest rates. And boy, here's a good link with other readings, maybe even not only in other levels as well, but clearly in level 2. The cost and availability of capital as it relates to things like, oh, hey, what is the central bank doing? Is the central bank lowering interest rates and telling all of the financial institutions out there, okay, here's tons and tons of money, you guys do with it what you want. So interest rates are low. That's one element here, but also what is the actions and the intentions of central banks? Demographic factors, environmental issues, new property lead time, unexpected inflation. There's a good one. what the institute could do in the question stem is say something like, okay, here's some kind of a price index last year, and then here's what it is today. And so, you can go ahead and compute a rate of inflation. However, that's kind of like an historical rate of inflation, but it's super important to try to determine what that response is going to be to unanticipated or unexpected inflation. I remember when I was in graduate school, the professors always tried to get us with the difference between, okay, this is what we're thinking is going to happen versus, hey, suppose we have some event and something happens, a spike in oil prices or a spike in natural gas prices, or as we're going through now early in 2022, a spike in, the price of cereal and the price of sugar. Every time I go to the store and I put my debit card in there, it's always more. All right, how about let's continue with this idea of economic value determinants, and then I want to swing back to what I said in that very first slide. So role of real estate in portfolio. So I want you to think about the big picture. We have a bunch of equity securities, of course. We have a bunch of fixed income securities, of course. And then we have a bunch of these alternative things. So inside of that alternative universe, we're concerned about things like, okay, miniature golf courses that we might own, property buildings, post offices. And what do they provide us with? They provide us with bond-like characteristics. This is what I said earlier. Here's income, so periodic rent payments. And then stock-like characteristics, of course, capital appreciation. And so essentially what we're going to do is look at these as twofold, right? We're going to add those together and get the total return on our real estate portfolio, but make sure that you can answer a question on which part of your real estate portfolio looks like a bond and which part looks like a share of stock. And then let's go back to level one and ask ourselves the basic question, why are we going to make this investment? And the answer is, well, because it has a positive net present value. And remember what I said earlier, that we've got to have, a little bit of a unique terminology here inside of our real estate universe. And this is what we have in that last circle point there, right? The investment return, maybe that's an internal rate of return, maybe it's a holding period return, but it's some kind of a rate of return that ought to be greater than the interest rate on the loan. Look at that last light brown circle point. Using leverage can increase return. And what we probably should have done, we should have probably said that CAN, we probably should have put it in the big old bold and red letters and have it flashing out at you. This is what I tell my students all the time. There is beauty in leverage, right? If your returns exceed the interest cost, then everybody's happy. But there's also ugliness in leverage. If we take that greater than sign and flip it, that leads to really bad things like financial distress and bankruptcy and all sorts of sorrow. So using leverage, of course, can increase returns. This is what I tell students all the time. Leverage magnifies returns. Leverage magnifies positive returns, and it magnifies negative returns. All right, I think I've answered this one here pretty much. Why invest in real estate? And this is a great motivation question. There we go. Income, appreciation. And this is what we noticed in 2021 when we had lots of spikes in inflation. Of course, we expect that to continue in 2022. That owning real estate is at least a fairly effective hedge against inflation. It's not a perfect hedge, so don't think about that. And then, of course, you have to worry about things like, what is the government doing in terms of controlling rents and et cetera, zoning and all those kinds of other things. But I think this is a good thing to remember. Look at what we have here. Both rent and property values are expected to rise during inflation. And so I would be way more comfortable if you guys think about that, not with a period at the end of the sentence, So both rent and property values are expected to rise during inflation, conditioned upon other stuff, like governments and zoning and all those kinds of things, although that's probably not too important for this LOS and is probably not part of the reading. Diversification, everybody knows this. Of course, an apartment building commercial real estate, miniature golf courses, retail outlets on the boardwalk. Ownership in these and the returns on these are, of course, not perfectly correlated either in the equity market or in the fixed income market. In fact, there are lots of studies that show that properties can have correlation coefficients that are close to zero. And so that's perfect, of course. So what do we have with equity and fixed income? We like income, right? And we like capital gains, but we also like diversification. So of course that applies here. And then there are some different tax treatments depending on which country in which the property is located. So there might be favorable tax treatment. And I'm guessing the Institute would have a sentence somewhere up in the vignette or in the question stem that would say something like, hey, we're operating in this country over here, and they treat dividends or distribution of earnings a little bit differently than they do over here. And so you'll get the sense that there's a favorable tax treatment. How about continuing on this economic value determinants? All right, so cash flow contributors. I tell my students this all the time, and this is exactly what this LOS is saying. That what do? We invest in projects that have positive net present values. That means that projects have lots and lots of operating cash flow. Well, look at those first two diamond points, right? Rental income, so we want that top part of the income statement. We want lots of income. And then operating expenses, we want to be super efficient. And so what that leads us to then is lots and lots of maybe something called net operating income. But then since real estate tends to be so highly leveraged, then we need to worry about the cost of debt. We need to worry about the amount of debt. So we have leverage there. And then capital expenditures, of course. If we own a miniature golf course, we have all these kids, putting and taking the golf club and smashing it onto the carpet for each hole. So we're going to have to replace the carpeting on our miniature golf course, and of course that's a relatively minor expense. But think about expanding that to a huge, 100-story office building when you have to replace all sorts of things like elevators and computer equipment and air conditioners and roofs and all that kind of stuff. How about this leverage? Depends, of course, on supply and demand, and those are going to contribute to that. What did we call that just a few moments ago? Maybe the internal rate of return, maybe the holding period return, where that leverage can magnify the returns in both directions. Here's an interesting slide. What I took away from this when I first looked at the reading is the first column. What is the most important factor? And this is economic growth, right? When the economy is growing, everybody's happy. Everybody has more income, so they're going to demand more stuff out there. And that includes things like apartment buildings and residential offices and even miniature golf courses. So that's probably a really good one to remember, since there are a whole bunch of ones in that column for all of the different sectors inside of real estate. And then it's probably good to memorize the other end of the extreme, retail sales growth. Notice that most of those are fives, with the exception of shopping centers and maybe retail centers. And then notice there's a bunch of 2s, 3s, and 4s in there. Those are probably don't lend themselves to be great exam questions. So if you remember job creation, population growth, and supply and demand for new space, those are somewhere in the middle. You could probably answer a question on the exam. All right, types of commercial property. Office property, of course, demand depends on growth and employment. Now, of course, this institute claims that it doesn't use current economic events, so you won't get anything about spikes in inflation in late 2021 or early 22, which means that you probably won't get any kind of a COVID-related question. But I would be prepared for a question that says something like, hey, there's a pandemic out there. What does that mean? And so it's not really specific to COVID, but if I were creating a question, there's absolutely no doubt in my mind that I would throw some kind of a health concern in there. And so what does that mean? Of course, people are going to be working from home. You guys are living through that even as we enter 2022. Yeah, so what does that mean? We need to worry about things like net leases and gross leases and expense reimbursements. All those things depend on the pandemic and growth in employment. And of course, whether or not people feel like going back into the office. I mean, my take is that, I don't want to sit at home and teach my classes online, which I had to do. Well, boy, that was a year ago, but I've been back in class now, and I'm looking forward to starting teaching next week as well. How about industrial and warehouses? I can't help but think, and I'm guessing that you probably think along similar lines, is that think about the warehouses for Amazon. They're popping up all over the place. They are all over the place. In fact, there's a handful of them just opened up in my area. And so what is this? Depends on the strength of the economy, and that makes perfect sense. Retail, what are these trends that we've got to look for? Population growth, job growth, overall economy. There again, that overall economic growth with GDP, that pops up in here. And so look for some of these in the question stem. Boy, look at that second arrow point there. Lease terms vary depending on the quality and the size of the property. So this goes all the way back to Modigliani and Miller. Quality of the asset, the ability of the asset to generate cash flows. Hospitality, once again, think about the pandemic. Motels and smaller hotels, limited amenities, close proximity to major highways, tourists and tourist attraction. I'm guessing that everything that you've read about and learned during the COVID, you would be able to answer questions on both retail and hospitality. Multifamily over here, population growth, that's probably important to remember. Here's a good LOS. This is an LOS that could probably pop up in almost every reading. Before we make some kind of investment, what do we need to do? We need to put on our working gloves, we need to get out our shovels, and we need to get dirty. That's what I think of in terms of due diligence. Investigate the facts and conditions that might affect the value of a property, which is all that stuff that we've been talking about over these last couple of slide decks. So here are a couple of good activities. Review leases, examine operating expenses, contamination. This is a super important one for a variety of reasons, not least of which is that, of course, we don't want to have a property where we're going to impact the health of our workers and our guests or our clients, but clearly we want to make sure that this is safe for the overall society and overall environment. Here's another way to link this particular LOS with the reading on ESG investing. How about that fourth one there? I'm guessing that you guys are eating this one here like you're having a nice dessert, reviewing cash flow statements. As good financial analysts, this is what we love to do. We're diving into those financial statements, especially the cash flow. Here's a good one, examining property tax history. Once again, you need to be aware of what the local government thinks and views about property taxes and what those property taxes fund. Surveying the property to confirm boundaries and identify easements. This is a good one. I always go back to one of my favorite television shows. You guys ever watch Sanford and Son? He wanted to identify the property line between his property and his neighbor's property, which was also a junkyard. And it turned out he thought the property was way over there, and it turned out the property line was right outside of his door. And so Fred was not very happy about this. But this is super important to be able to make certain that you know where property boundaries are, and you can know how you get away that way and this way. Legal documents, examining these. Of course, the CFA Institute is not asking us to be lawyers, but they want us to be able to think like lawyers, so we need to examine those documents. Moving on here in public real estate investments, so outstanding lease terms, cost to release spaces, financial health of tenants. Oh boy, I scratched my head on that one when I first read that in the reading. That's a tough one. It's not like you can go around and saying, okay, are you coughing today? market competition. In my mind, this is a super important one. Of course, we have an apartment building and then there's 4 apartment buildings across the street. We need to make certain that we are aware of that competition and what the competitors are doing. And what that does is that leads us to be able to identify I tell my students this all the time, strengths, weaknesses, opportunities, and threats. There's that SWOT analysis that pops up all the time. Relevant qualifications of senior management. I have my undergraduate investment students every semester, they do a recording over in the library on a particular mutual fund, and I require them to tell me about the qualifications of the fund managers, and they're keenly aware of my emphasis on CFA stuff. And so whenever they're presenting and a mutual fund manager holds the designation, they always highlight it and they say, hey, look, Jim, here's a guy or a girl who they know what they're talking about. So, whatever that means. How about we do some quick math here? Discuss real estate investment indexes. Notice what we have in green there. What did I say earlier? And I think multiple times here. What do we want out of any kind of investment? We want cash flow, right? So let's call that net operating income here, and then let's subtract out capital expenditure. So I want you to think about this. Now, don't tell your finance professors that I said this, but this is a good way of thinking about this in the big picture. You think about that net operating income, relate that to the similarities with operating cash flows, the amount of cash remaining after all expenses have been paid. That's kind of what that is. Not exactly, but kind of. And then we take out capital expenditures. And so this is pretty much what we did to get free cash flow. So we take out all of those expenditures, so we get, the amount of cash remaining after all expenses have been paid and all investments have been made. So that's kind of like the income component. And then over on the right-hand side of the plus sign, we get a capital gain there. So total return on the individual property is really just income and capital gain. Now, those returns can be measured in any way. The reading discusses holding period return. The problem here is with the ending market value and the beginning market value. What do those things mean? Boy, it would be great if we could see our properties being bought and sold just like they are on the floor of the New York Stock Exchange or the New York Bond Exchange. But of course, we know that that's not true. That's what makes real estate unique. So these are based on appraisals. So here's my advice here. Let's make sure that we go out and get somebody to appraise it that sounds super important, like Gibraltar appraisals. We've been around for 1,000 years. We know what we're doing. Rather than going and hiring someone like me, hey, here's Jim's appraisal. You know what? I live here. I can pretty much guess what that property is worth over there. So make sure that those appraisals have their roots in everything that Modigliani and Miller taught us back in 1958. And then look at our last circle point down there, right? The bullet point appraisals are not actual sales, of course, and they can be biased. So what we need to do is we need to get our vice and we need to try to squeeze that bias down to close to zero as possible. Now let's go ahead and talk a little bit more about some specific disadvantages of using appraisals. So there's this appraisal lag. So what am I doing? I'm going to go over there and I'm going to evaluate this miniature golf course. And maybe this owner runs and manages and operates, let's say 5 miniature golf courses down in some beach town. So I'm going to go over there and I'm going to appraise those. I'm going to look at those 5, right? And so I'm going to say, okay, there we go. It's worth, let's say, $1 million, whatever that number is. So today it's worth $1 million. However, what happens if some of these economic conditions change? So what do we have right there? In an upward market, boy, those values of those mini golf courses are going to change faster than I can get back and reappraise and reevaluate. Yeah, so look at the second arrow point. Properties are not appraised every quarter. So how do you know how much the property has changed in value? As the owner, you have a suspicion because you either have tons and tons of people who are playing mini golf every day, or maybe you have no people playing mini golf every day. And so you have a sense of how that's going to impact value. Now, of course, appraisals and the appraisal lag will tend to smooth the index, which means it reduces its volatility. So notice we have that in bold there. So that's probably a really good thing to remember for the exam. Appraisal lag leads to even lower correlation with other asset classes. So think about that. You have this lag and you have estimates of value, and you're computing a correlation coefficient against equities and fixed income securities, which are trading all the time. So there are kind of two components to lower correlations. The concern there is that you may estimate a correlation coefficient between the mini golf courses and your equity portfolio. You may think it's 0, but because of that lag and because of the appraisals, maybe it's 0.4. So the risk here is that you think you're getting more diversification than you actually are. So there are ways to handle this. You can unsmooth the index, and then you can use transaction-based methods. And so to do this, there are ways to unsmooth, and then there are ways to find transaction-based. We'll do that here in just a few minutes. So let's go back to my miniature golf course example. Boy, how many times do miniature golf courses at the beach and in beach towns, how often do they change hands? I don't have any idea what the answer to that is. I mean, we could go and find some legal documents that are registered inside that municipality, but we can do our best to say, okay, how about if we just go up the entire East Coast or West Coast if we're living over there, and say something like, okay, from Virginia to New Jersey, there's, boy, how many different miniature golf courses? Those of you who don't live anywhere near the East Coast, how about if I just pick a number? How about 1 million of them there? And so you have a choice. And so miniature golf courses in New Jersey probably have similar cash flows as they do in Virginia. So maybe it's possible, and it's maybe even likely, to find actual transactions that are not right across the street. So that's important to remember. And then remember what I said just a moment ago. There's an economic technique, econometric technique. There's some kind of a regression-based analysis that we can go back to our quantitative methods and say, okay, maybe we want to use time series, maybe we want to use cross-section, maybe we want to do something. So here's another great link between alternative investments and another reading out there. All right, how about transaction-based indexes? So repeat sales index based on a repeat sales of the same property. So you have to decide, all right, what does repeat sales of the same property mean? Does that mean once a month? Probably not. Does it mean once a year? Well, that sounds like too long of a time period. Notice we have in bold there the reading mentioned, sold twice in each quarter. Now there's an hedonic index. Of course, that word hedonic relates to the word pleasure. And remember, economists, they like to deal in utility. So they use the word utility to substitute for satisfaction, which can be a substitute for pleasure. So that's the only reason why this has a name, hedonic index. What this means is there's only one sale, so you get one pleasure out of a sale or a purchase, and so you can throw that into the computation of the index. And notice what we have at the bottom. Transaction-based indexes can be very noisy. All right, so how do we value this? Well, we know this from Modigliani and Miller. What are we going to do? We're going to try to measure the quality of the asset. Now, there are a couple of different ways to do this that are unique to real estate, but we're going to use those same M&M principles. So cost approach, sales comparison approach, and income approach. And those names suggest exactly what the process involves. So the cost approach, there's no way that you would pay more for a property than it would cost you to go ahead and buy the land and then construct the building or whatever it is that you're there. Cost approach. Sales comparison approach, there's no way that you would pay $1 million for this property here if other people in similar areas were only paying $500,000 or $600,000 for similar and almost, I'll say almost identical properties. And then here's the approach that is, of course, most related to what Modigliani and Miller taught us, the income approach. Value is equal. Boy, I love saying this to my students, the present value of what you expect to get out of your investment. All right, two ways here. These are probably really good exam questions, and you'll see the obvious notion and the differences between these two. All right, direct capitalization versus the discounted cash flow. So what are we going to do? For both of these methods, we're going to take a look at the property and we're going to say something like, okay, next year, what do we expect to get out of it in terms of cash flow? So we'll call this net operating income. So notice under the column with direct capitalization, we're going to have a capitalization rate that's applied to net operating income in that first year. That cap rate is implicit of expected increases in growth. I'll show you what that means here in just a second. And what this method does, it's a simple method, and it relies on the notion that, all right, we're probably in a much better position to predict what's going to happen during this next year. And then let's just suppose that it repeats indefinitely. The discounted cash flow method is we're going to identify a holding period. Maybe it's 3 years, maybe it's 10 years, maybe it's 1,000,000 years. Probably not 1,000,000 years, but it could be longer. And what we're going to do is we're going to estimate cash flows over that holding period, and then we're going to discount those back to the present. Notice what happens here, whether we use direct or the discounted cash flow method, we're going to arrive at a value. Let me show you what that means here. So here's this income approach, the direct capitalization. What we're going to do is we're going to compute that net operating income in the first year. So let's look over on the right-hand column. What did I say earlier? Think about net operating income as kind of like, not identical, but kind of like operating cash flow. So what do? All right, we're going to start with rental income if fully occupied. All right, whatever that means, we're going to take that rental income. So that's like our perfect scenario. And then we're going to add other income. And this other income could be almost anything. You know, for example, not too far from where I live, a group of individuals bought some land and they built a golf course and a hotel on this property. And so, of course, the golf course and the property, I'm not quite sure which one is which one is the main income generator, but either one. So they've got the two incomes from the hotel and the golf course, and they have a driving range. All right, so there's some extra income, other income for people who don't want to stay overnight and people who don't want to play around a golf. They can go and hit balls. They also have a miniature golf course for, you know, when the weather is nice, so people can come and play miniature golf. They also have an outdoor bar and grill, and they also have a mini shack where you can just stop. Anybody can stop in and buy a slushie or a hot dog. So those are all examples of other income. But I mention this because they do something really cool in the wintertime. They turn their driving range, which you tee off here, and the driving range is upward sloped. And so, of course, people are trying to hit it over the hill. But what they do is they turn it into a snow tubing over the winter. So there's all sorts of other incomes that can be added to that fully occupied rental income. So make sure when you're reading the question stem that you're aware to include that other income. So that gives us something that we call potential gross income. So this is like the best case scenario. And then we take out all the stuff, right? We take out vacancies and we take out loss of sales and collection losses and accounts receivable that are not going to be paid and all that kind of stuff. Effective gross income. Then we take out all of our operating expenses, and then we get net operating income. So think about it. That's like operating cash flow. And then, of course, we might have some transitory or temporary gains or losses that we'll have to throw in there, and that will give us what the reading calls stabilized net operating income. Now, under this direct capitalization method, what we're going to do is estimate that for the first year. Under the discounted cash flow method, we're going to estimate it for each year during the holding period. So let's go ahead and work through just some super quick examples here. So look in the red there, property value, that's net operating income. Notice there's a subscript 1. This is what I was just talking about. And we're going to divide that by some kind of an interest rate minus some kind of a growth rate. And you should be saying to yourself, okay, Jim, I'm waiting for it. What was that guy's name that we learned about? This is the Myron-Gordon growth model. This is the dividend growth model that we learned back in level 1 applied to an investment in real estate. So once again, all the stuff that we learned from Modigliani and Miller and Myron-Gordon and William Sharp, they're going to apply to all sorts of investments throughout and across all asset classes. All right, so let's skip back up to that first arrow point. So we're going to call this the required rate of return. A lot of times it's called the discount rate. We're going to start with the risk-free rate, and we're going to add a risk premium. So this comes right out of William Sharp's capital asset pricing model. Now that risk premium is probably not going to be directly the result of CAPM, but we're going to add some kind of risk premium that depends on, boy, I don't want to hit my back button here, but in your mind, go back to all of those variables, the economy, sales growth, demographics, go back to all of those principal risks, and we'll add some kind of a risk premium. But here's the most important one here, right? We know about the GDP, but we also need to worry about leverage. How much does leverage increase, and how much should that be reflected in that risk premium? All right, so that's our discount rate. Now that cap rate is going to be the discount rate minus the growth rate. So notice that growth rate is shown in the denominator. So look at this example. We have one here at the bottom half of the slide deck. Net operating income, $200,000 for the next year, cap rate of 10%, the value of the property, you just take the $200,000 divided by the 10%. And don't forget, boy, I hope I'm not offending you when I say this, don't forget to use the decimal form in the denominator. So there's our property value of $2 million. And remember that what we're doing is we're just automatically assuming that net operating income is increasing in year 1 is increasing by G, by the growth rate. So there's an implicit assumption here that same thing we talked about with the Myron-Gordon growth model, that the growth rate is constant. So all we're doing is taking a present value, and this is over a perpetual, over an infinite stream. Now, on the other hand, let's suppose that we don't intend to own this property over an infinite stream. All right, so what are we going to do? We're going to say something like, okay, let's suppose that we have net operating income for the next 3 years of $200,000. Let's just make our life easy here so we can do the math easily. So there's no growth, 200, 200, and 200. But then in year 4, after our holding period return, that increases up to 300,000, discount rate 8%. Terminal growth rate of 1.5%. So what's going to happen is that we have constant growth, 2 over 3 years, and then we're going to jump up to 300, and then that 300,000 is going to grow by 1.5% over the next infinite time period. So all we're going to do is take that 300 divided by 0.08 minus 0.015. And we get, what do we get there? 4.615 million. Everybody see that under the solution. And so what that is, I want you to think about it this way, is that's kind of like our expected selling price. So we're going to pay for this today. And then at the end of year 3, we're going to sell it to somebody for $4.6 million who expects to get 300,000. And that 300,000 is going to grow by 1.5% over that infinite time period. So think about what we're getting out of this. You ready? We're going to get some income, right? 200, 200, 200. And then right after we get our last 200 in net operating income, we're going to sell it for $4.6 million. How much are we willing to pay today? So this is a super easy time value of money calculation, right? N equals 3. The interest rate is 8%. The payment is 200. That's right, the ordinary, regular old annuity, 200, 200, and 200. Oh, excuse me. And then our selling price is $4.6 million. So that's going to be our future value. So go ahead and hit the compute present value button and we get $4.1 million or so. And so think about this. This is exactly what I said in the very beginning. What are we getting out of this? We're paying 4.1 million, right? What are we getting? Income. We're getting 200, 200, and 200 for 3 years. And then we're going to sell for 4.6. So we buy for 4.1, we get some income, and then we sell for 4.6. We get the income and we get the capital gain. What is the value? Boy, this comes right out of Modigliani and Miller. We're willing to pay today an amount that's equal to the present value of what we hope to get out of this thing. Now, of course, the hoping what we get out of this thing depends on, let's swing back up to the question stem. It depends on things like the discount rate. It depends on things like the terminal growth rate. And it depends, at least in this case, that we're expecting that net operating income to increase in value from 200 to 300 in year 3 to 4. Imagine a problem that you went from 200 maybe to 210 or 225. And so in that intermediate solution, you're going to get a number that's way less than the 4.6 million. Now, of course, you can't have any kind of due diligence inside of an LOS without saying something like, all right, there's got to be a ratio in here that we can use to determine whether or not this is a valued investment. So here we go, financial ratio. So debt service coverage ratio, and that's simply equal to the net operating income divided by, make sure you put both interest and principal in the denominator. And then the loan to value ratio, I'm guessing that you guys know this. Of course, everybody who's ever bought a house knows what a loan to value ratio it is. Notice that we have an exam tip at the bottom. In purple, maximum amount of debt that an investor can obtain is the lower of the loan amount based on both LTV and the debt service coverage ratio. Now, how about if we extend that conversation to analyze and evaluate some of these real estate investments? All right, so what we're going to do, this equity dividend rate, the reading also refers to it as cash on cash return. What we're going to do is calculate this when debt is used to finance real estate, of course. So the equity dividend rate is equal to the net operating income minus that debt service divided by the equity amount. Now, this is only a 1 year holding period return. And so this is probably not going to be anything that looks like an internal rate of return. What we're going to do is we're going to try to do this over time, and we can then compare an internal rate of return to maybe a compounded equity dividend rate. So let's go ahead and take a look at a quick example here. 8% interest only loan. As long as the one ratio is at least 1.6 and the other ratio does not exceed 60%, appraised for 1.8 and net operating income is 400,000. So let's go ahead and use the debt service coverage ratio. So all we're going to do is take the 400 over the 1.6. That gives us 250,000. So that's going to be our numerator in the next computation. And so if you divide that by the interest rate, remember decimal form of the interest rate, you get $3.125 million. If we rearrange that loan to value ratio, we can just take 60% of the 1.8 million. That gives us 1.08 million. And so we're going to take the lower of those two, and there's the maximum amount of the loan. And so this addresses the part of the analyze and evaluate private real estate. So you may or may not, in the analyze and evaluate, you may or may not have to calculate those. All right, moving on to types of real estate investment trusts. All right, these are tax-advantaged companies that own, operate, and develop income-producing real estate. So there are equity REITs and mortgage REITs. Excuse me. Let me go back and say something about the tax-advantaged companies. So this is probably due to different ways that different countries treat the distribution of dividends to the owners. So look for some sentence in the question stem that might say something like, oh, here, these dividends or capital gains or whatever they want to call it is treated like this over here in one country and it's treated like this over here in another country, and you ought to be able to make a determination of which one has the tax advantage. And of course, the real estate operating companies, they probably don't have that tax advantage. And then mortgage-backed securities, we know all about this from other readings. All right, how about the use of net asset value per share in REIT evaluation based on forecasted cash net operating income? So we know about net asset value from level 1, and you know about net asset values from all of your investments in mutual funds. And so we're going to do something similar here. Estimate the value of operating real estate by capitalizing the net operating income. So we're going to deduct non-cash rents. We're going to increase current net operating income to reflect the full year. And then we have to come up with some kind of a growth rate. And let me repeat what I said earlier, is that this is a huge assumption, right? We could just say, oh yeah, we're going to grow by 20%, which may or may not reflect the economic conditions. So make certain that when you answer the question on the exam, that estimated growth rate is a sustainable growth rate, that it's reasonable, that it makes sense based on economic conditions that are provided inside of the question stem. All right, so that's step 1. We come up with these inputs here. And then what we're going to do is we're going to do all this stuff here in the bottom, which is similar to how we computed net operating income earlier. Now, I said this earlier, I think it was that first slide, about funds from operations and then adjusted funds from operations. And so these are probably two formulas and 2 equations that you ought to memorize. Even though the LOS doesn't say, go ahead and compute, the LOS, at least at this stage, tells us to just describe. But of course, computing also always helps us to our understanding of descriptions. All right, so funds from operations. So accounting net earnings, which looks an awful lot like stuff that we've done so far in Modigliani and Miller and what we've done inside of this slide deck. And then we're going to add depreciation expense. We're going to add deferred tax expenses. And so remember, CFA Institute, they don't really require us to be CPAs, but they want us to think like CPAs. So I'm guessing that they would just throw deferred tax expenses in there and you'd have to add it. And then gains from property sales and any debt restructuring in there. Now, we can look at this from kind of a more global perspective. If we're given earnings before interest and taxes and depreciation and amortization, if we're given that, then all we need to do is take out interest expense. Then, of course, we want to make some adjustments to those funds from operations because they're kind of like accounting income, right? We want to adjust it to make certain that we know about cash available for distribution or cash available after all expenses have been paid. So this is kind of like the similarities between, accounting income and operating cash flow. But look at that second embedded circle point. This is a more accurate measurement of current economic income. So that's probably super important. So why do we make this adjustment? Well, we do it for those 2 reasons. What I just said, we want to make sure that we're looking at cash, and then we want to make sure that we're evaluating this based on current economic income. All right, so there's our adjustments there. We're going to start with the funds from operations, and then we're going to make some adjustments, right? Non-cash rent, recurring maintenance, and then capital expenditures. And so those are all similar to what we did back in net income, to operating cash flow, to free cash flow. But once again, they're unique and specific to the real estate environment. Now, here's a good example in which we're going to actually calculate and interpret the value of this REIT share. So my advice is to go ahead and pause this slide I don't want to waste your time and everyone's time going through all these. So we're given a whole bunch of stuff over on the right-hand column, and we're asked to, look at the bottom left, calculate the REIT using net asset value, two comparables, and then discounted cash flow. So that's what we're going to do over here. So go ahead and why don't you get out your phone and take a picture of this slide, and then you can refer back to them as we go through all this. All right, so let's do net asset value here. We can do this on one slide. Let's calculate the estimated value. So we're going to take that 70 million divided by 0.07, right? So that gives us, boy, a big number, right? So that's $1 billion. So calculate the net asset value. So we're going to add some of those balance sheet items, right? We're going to add cash and cash equivalents. We're going to add accounts receivable, and we're going to subtract out the debt and liabilities of 300. So we get, what is that? $780 million. To get the net asset value per share, all we do is take that and divide by the number of shares outstanding. So I'll go ahead and toggle back here real quick. Those of you should be looking at your phone. All that information is right here. So that gives us net asset value 78. How about if we use this price to FFO comparable? Let's just take the FFO, which, right, that was given to us right there at the top, 60. We'll divide by the 10 million. That gives us $6 a share. Multiply that by the multiple of 10, and that gets us 60. So here we've got 78 using net asset value. Here we have 60, and then of course we're going to get a different number here with the price to the adjusted FFO. So we're going to take those non-cash rents, right, of 60, and then the recurrent maintenance type expenditures of the 2.5 and the 10. So that gets us down to 47.5. Divide that by the 10 million outstanding shares, and that gets us the adjusted FFO of 475. But remember, we have a different multiple, so that multiple is 14 because of the adjustments, right? And so that gives us 66.50. How about we move on to approach 4, and this is what we did a little bit earlier. Let's call it the Myron Gordon growth model version. The reading calls it the discounted cash flow model. And so what we're given in that table a few slides back that you can look at on your phone, if you did take a picture of it, notice that we're given dividends of $5 1 year from today. And those dividends are going to grow by 2%. So they grow to 510, and then they grow to 520. And then after 2018, they grow by just 1%. So that gives you that 525 out there. So in order to compute the value, the first intermediate step is for us to compute what we call terminal value just a few moments ago, and what you should have learned back in level 1. So all we're going to do is take that first normal dividend, right, that 525 out there after the holding period, and we're going to discount that back to 2018. So notice in the middle during step 2, we take the 525, divide by the 0.09 minus 0.01, and we get 65.63. So swing back up to the table. So this is what we're going to get out of this REIT. We're expecting to get a dividend of $5, then a dividend of $5.10, then a dividend of $5.20, and then we expect to sell it and get $65.63. So this discounted cash flow then tells us to just take the present value, and that's what we've done in that final row down at the bottom of the table where you can read present values. And so forget about that 63.57 for just a second. So the present value of the $5 is 459. The present value of the 510 is 429. And the present value of the 520 plus the 65.63 is 54.69. And by the way, there might be some rounding in there. And so if you sum those, you get the 63.57. So there's step 3 at the bottom, the REIT value per share, 63.57. And so let's just do a quick recap here. So $63.57, $66.50, $60, and $78 using those 4 different approaches that we had down the left-hand column, given the table on the right-hand column. And so notice there's a whole bunch of stuff there. The CFA Institute could give you this as a as one of those short vignettes with 4 questions, and they could say something like, okay, here's all this stuff, and approach 1, approach 2, approach 3, approach 4, compute those net asset values according to those 4 methods, and there you have it. All right, moving on to this final LOS, explain advantages and disadvantages. And we've probably talked about at least a handful, if not most of these, so I'll go through these last slide or 2 fairly quickly. Advantages of investing in public real estate. So even though there's a liquidity issue, it's less of an issue with public real estate. And of course, the REITs and the REOCs are traded on stock exchanges, and so that liquidity is at least daily. And of course, you don't have to spend the $1 million that I talked about with those miniature golf courses on the floor of the New York Stock Exchange. Those values are $10 or $20 or $30. So lower investment. Limited liability, same thing with investing on the floor of the New York Stock Exchange. As we always have, access to different kinds of real estate. I mean, back when I was in graduate school, this was the word that we used was called spanning. It used to be you could invest in stocks and bonds and treasuries, and that was pretty much it. And then when you span, you chop those up into different kinds of possible investment opportunities. And so when I see access to something, in this case prime real estate, I'm just thinking of spanning. Of course, professional management services, diversification, taxation, and transparency. Disadvantages. Oh boy! So remember, one of the great things that we learned about alternative investments back in level 1 is that we want low correlations so that we can get lots of diversification. And the simple fact is, we know that on the floor of the New York Stock Exchange, all those equity securities that are being traded, whether they're individual stocks or portfolios of REITs or whatever they are, they have much higher correlations. And so we're going to get less diversification in the public real estate market. Costly to maintain the structure of a REIT. Dividends are taxed. So remember all the different tax implications. Minority shareholders tend to have little control. And because they're traded on an exchange, they probably have more volatility, which then is not compensated for income potential, maybe capital gain potential, but notice that second to last arrow point, moderate income growth potential. And then finally, I can't say anything in addition to what I've said before about all the stuff we learned from Modigliani and Miller. And so these firms, these REITs, they have lots and lots of leverage. And so whenever there is some kind of an economic event like rising interest rates, then these securities are going to be punished. How about advantages of private real estate? So there we go, low correlations. We were not surprised to see that. Direct exposure, stable returns. How about if I say more stable returns? That's what I'm looking for. Income and capital, we know that. Property performance drives returns. So think about Modigliani and Miller telling us that the quality of the asset determines value, and that's certainly true with real estate. Inflation hedge, might be a premium for illiquidity. We talked about that, and tax benefits. Low liquidity, high fees, low transparency. So what I would do is I would go ahead and take pictures of these 4 and just have those at my ready so you can memorize those. I think that's the easiest way to do that. And that takes us through those learning outcome statements.